Good evening, everyone, and welcome to this International Women's Day webinar, Closing the Super Gap, presented to you by Australian Catholic Superannuation Fund. I'm just going to go through a little disclaimer with you. The information provided to you this evening is of a general nature and does not take into account your personal and financial circumstances. Before making any decisions, you should consult with a qualified financial planner and also read our product disclosure statement, which you will find on our website. Good evening again, and thank you for joining us. My name is Georgette Isabi, and I'm one of the regional managers based in our Sydney head office. My job day to day is to meet with our fund members and assist them in their superannuation journey. I meet with our members at their workplace, such as schools, functions, and over the phone. What I love about my job is making a positive difference in the retirement goal and outcomes. This evening, I have with me joining me, Tina Tran. Tina is one of the fund's seniors planners. She knows how to get great outcomes for our members. Tina works with a wide range of Australian Catholic superannuation members and even takes time to present at our webinars when we ask her. So thank you, Tina. We know how busy you are. Thank you so much for joining us this evening. Tina, did you want to tell the audience what you love about your job?
Thanks for the nice introduction, Georgette, and welcome everyone. It's a pleasure to be here. I love talking about superannuation and particularly like to be able to help clients make sense of superannuation and how it can fit in with their retirement financial planning. And that's because superannuation can seem complex, but when we break it down into chunks, it makes it easier to understand, and you're going to be able to learn some of the basics today, and hopefully it will help you to get started, to get a better understanding and see how superannuation can help you put you on a path to a more comfortable retirement.
Exactly. Thank you. Well said, Tina. Now, I'm just going to go through some quick stats with you all. These stats were put together by Women in Super, which is a national advocacy and networking group for women employed in the superannuation and wider financial service industries. They interviewed over thousands of females, and they put these results of stats for us, which I'm going to share with you. To be honest, when I saw these stats myself, I found them quite confronting, let's see what you're going to think now. 40% of older single women live in poverty and experience economic insecurity in retirement. It's quite a scary number. Just less than 50% of the workforce are women. So that's a big chunk of the workforce are women. 44% of women rely on their partner's income as the main source of funds for retirement. And I can definitely relate to that because there is not that, I talk with so many members and they always say, oh, I don't have to worry about it. You know, I'm relying on my husband's superannuation. I can balance it, will be fine. 8.5% of women between age 65 and 74 still have a mortgage. So again, that's quite a big chunk. 44,000 is the average female salary. This includes part-time workers. So you can see that's quite a low salary. More than 5 hours on average is spent, women spend per day caring for children compared to men. Okay. Now, why is this superannuation gap created? We're going to go over why is this gap created. 43% of women work part-time, which means that they're not in the workforce long enough to be able to eligible and to receive that superannuation payment from their employer. Women on average take 5 years out of the workforce to care for children or family members. So once again, they're not in the workforce long enough to receive that superannuation, from on behalf of their employer. On average, women work full-time, 18% less than men. So once again, their salary is less than what men earn, which means that they're not receiving as much superannuation as men would. Just over 200,000 women miss out on superannuation altogether, as they don't earn the minimum $450 per month before tax from one employer. So in order to be eligible for superannuation, you do have to earn more than $450 gross per month. And we can see that more than 200,000 women miss out on that. So that's, again, it's a very, very, very huge number, I think. So now that we've gone over these stats, we're going to actually what we're going to present to you today. Again, thank you for joining us this evening. Now we're going to ask you if you have any questions to write them. You should see on your screen there is a chat box there. You can write the questions in your chat box, and towards the end of the presentation, Tina and I will answer any questions that you have this evening. And thank you again for joining us tonight. You've given up watching TV or going to the gym and whatever else you're doing to relax tonight to be with us. So we really appreciate it. Just going to go through now what we're going to discuss with you today. Always knowing more can lead to better super outcomes. I'm just going to go through some super basics, just to explain about superannuation to you a little bit. Have you consolidated? Do you have more than one superannuation fund that you need to consolidate into one account? Can you contribute more? Do you have the ability to contribute more? And also ways of contributing, we're going to discuss that as well. Do you have life insurance within your superannuation account? And we're going to have a quick look at the investment options, or how we invest the funds for our members with Australian Catholic Superannuation Fund, and also we're going to look at discuss what you can do right now to have a better superannuation outcome for your future, and also we're going to discuss some benefits of financial advice as well. So we always know that in life, when you know more about a subject or a topic, you can take a better informed decision, make better informed decisions, and have a better outcome for your future. Same goes with superannuation. By now, looking at the stats that we just looked at before, we can see that there's definitely a gap between male and female superannuation account balances, which is quite scary. However, learning more about how super works and what you can do to boost your superannuation account and when you can access it is very, very important. And that's what we're going to discuss with you today. Empowerment can always lead to better outcomes. So Tina and I are hoping that we can assist you to make a positive step towards your superannuation outcome for the future. So let's get started. Superannuation is a way to help ensure you have funds for your retirement. So we know that the government introduced this superannuation guarantee back in '92, so this is years ago now. The reason for that was because they didn't want people to be reliant on the age pension, and they wanted us to be self-funded retirees, so that they'll have less people that they have to pay the pension for. So depending on your age, preservation age, you can access your superannuation as early as age 60. For anyone who's born after July 64, 60 is the age that you can potentially access your superannuation account. As long as you're eligible, your employer will automatically pay super into your account when you're paid. So we discussed earlier that the eligibility, it comes when you're earning more than $450 gross per month. And that is when your employer is obliged by the government to pay currently 9.5% superannuation guarantee into your superannuation nominated superannuation account. That rate is legislated, or not proposed yet. It's proposed at the moment. It's not legislated to go to 10% from July, and hopefully by 2027, the rate will go to 12%. So these are just some superannuation basics, just to make you understand what superannuation, why it was introduced, and how it works. A little bit about Australian Catholic Superannuation Fund, if some of you may or may not be familiar with Australian Catholic Superannuation Fund. When you're eligible member of the fund, we provide you with life insurance. That is, you're covered for death, disability, and income protection. You don't have to have that life insurance if you don't want to. You can always take it out of your account. However, we do provide it to you based on your age, and then you can always increase it, or as I said, you can always cancel it as well. We provide holistic advice, and that is financial planning advice to the members of the fund. And Tina will explain a little bit further in the presentation as to how that is and how you can benefit from it as well. We are a value-based fund. For almost 40 years now. We have provided superannuation for a range of Australians within which focus in the Catholic sector and education and community organizations. Our mission is to empower our members to live their best retirement. So that is what we do as a fund, and we're very proud of that. We're always looking at innovation, and we're always looking at providing our members with products and services that can support them, and that can make it easier for them to access their superannuation as well. We have a call center that is award-winning call center. We have our investment option, which is the lifetime one option, another award-winning product, and we just continue on innovating, which is excellent. Now, with consolidation, this is one of the things I'm very passionate about. Just over 20 billion funds under management the ATO is holding on behalf of people that they don't know who the money belongs to. So you don't want to be a statistic. If you have more than one superannuation account, even if there is no reason for it, then I would urge you to look at perhaps consolidating your accounts. It's quite easy now to consolidate if you're a member of Australian Catholic Superannuation Fund. The way you do that is you need to register for a login to your account. You go to our website, click on login, have your client ID, and then you can log into your account and you can actually request to consolidate your funds by our online service that we provide to you. You can always bring our call center and they can also consolidate the funds for you over the phone, which is quite easy. Another way is if you have a MyGov account, you can log into your MyGov account and you can also request to consolidate there. Why would you consolidate is obviously because if you're paying two lots of fees in administration fees, if you're paying insurance premiums with two separate funds, you may not get paid out, especially for income protection. You only get paid out from one fund at the time that you needed it. So unnecessary fees, obviously, if you pay less fees, then you have a larger account balance at the end. So I would urge you to look at if you have several funds, if there's no need for it, to definitely look at consolidating them. And as I explained before, it's quite easy now to do it. In the past, it used to be you have to complete forms and all these things, IDs that you have to provide. That's no longer the case. Now you can do it all online. It's very, very easy. And when I actually talk to members and show them how to do it, they just can't believe how easy it is for them to consolidate these days. Now I'm just going to pass on to Tina. She'll take over from here. We're going to talk about if you can, can you contribute more? We looked at the employer currently pays 9.5% on your behalf to your nominated superannuation account, but you can always increase that balance. 9.5% may not be enough for you to live on. It may not provide you with a comfortable retirement. So what we can do is we can look at different ways that you can contribute more into your account. And Tina's going to explain the range of different ways and reasons why we should be looking at doing that. Thank you, Tina.
Thanks, Georgette. So you saw the gap between men and women in terms of superannuation balance. So one of the ways in which we can close that gap, you can't change your salary. If the salary is less than men, we can't do anything about that. But what we can do to improve our superannuation balances is actually put more money in and make it work harder. So Georgette mentioned before in terms of efficiency, and that's about making sure that your superannuation is consolidated. So you haven't got small accounts that are eating away, eroding with fees, and that also simplifies the arrangement. Now, the next part of how you can improve your superannuation outcomes is to make contributions. And contributions into superannuation is happening if you're employed, you're getting employer contribution, super guaranteed payments of 9.5%. So that's already happening for you. And if you're working life is 15, 20 years, 25 years, you're going to have a reasonably large asset by the time you retire. But for the majority of people, that is not going to be enough to provide a comfortable retirement. It will provide you with enough to cover the basics, but if you want a comfortable retirement, you need to add to that and do that through making contributions. Now, there's a couple of ways to do that. Contributions that you can make through salary sacrifice. That's where you arrange with your employer to have a portion of your wage before tax to go into superannuation. And that's very tax efficient because you're not paying income tax on that money, and you're going to get more going in without noticing the net result to that degree. And I'm going to go through a financial example to illustrate that. The other way in which you can make contributions is to make after-tax contributions. So I'll cover that in after we go through the concessional. Now, with these type of contributions, super guarantee payments, salary sacrifice. There's also the possibility of making a personal contribution and claiming a tax deduction. So again, that gives you the tax advantage because you're not paying income tax on that money. You will pay superannuation tax, that's 15%. But when you compare that to your marginal rate of income tax you would pay, there's going to be a tax saving and you get to keep that money. However, it can't be that great because unfortunately there are some caps or limits that are put in place. So the government's put in a contribution limit for super guarantee payments and salary sacrifice, and it's called the concessional contribution limit. And that limit is an annual amount of $25,000 per year, and that applies to everyone. The only time where you might be able to put more concessional contribution limit is if you haven't used up your contribution cap from a prior year. And so this was a legislation that was brought in 2018 and 19. So if you haven't used up your contribution cap from that time, you can have it carried over and use it in a future year. There are some other rules that need to be taken note of, and that is that it only applies if your total superannuation balance is less than 500,000. So if you're in that situation and you haven't used up your concessional cap for a previous year, it is possible for you to carry forward and make more than $25,000 in future years to make up for that. And that carry forward can go through for 5 years. So that's your concessional contribution, salary sacrifice, and personal deductible, and employer contributions. So why would you salary sacrifice? Well, firstly, if you have a look at the left column of this table, you can see the marginal income tax brackets. So for most people who are working full-time, they're going to probably have a salary somewhere between 45,000 and 120,000. And you can see the marginal tax rate for anything that you earn above 45,000 is 32.5%. So you're losing 32.5% of every dollar before it gets into your bank account. If you were to salary sacrifice, you are paying 15%. So it's going to go into your superannuation, but you're only losing 15%. So you get to keep more of your money that's earned, but it will go into your superannuation account, which you will get the benefit of it later on. So let's have a look at an actual example of the fortnightly pay and what the difference might be. So in this example, we've got someone earning $100,000 salary, which is a fortnightly amount of $3,846. On the left-hand column, this person doesn't make any additional contributions into superannuation. So their taxable income is just their normal fortnightly wage, and the payroll has taken out the income tax as per the brackets, and the take-home pay is $2,884. On the right-hand column, we have an example that you've decided, okay, I would like to start putting money into superannuation, and I've decided I can afford to put in 5%. So 5% of that fortnightly pay is $192. So the result is that your taxable income goes down by that much, and you will take home less money because you are putting $192 directed into superannuation. So your take-home pay goes down to $2,757, which is a drop of $127 a fortnight. So if you think about 192 is going into super, but I'm only giving up $127, and that's because there's a tax differential. And that tax differential equates to a $66 per fortnight tax saving that you get to keep. And annualize that over 12 months, it's $1,716 per year. And if you compound that over 10 years, that's $17,000. And that's not even looking at the result with compounding investment earnings on top of that. So you can see that a small contribution that you start making today can compound and make a huge difference to your retirement in the future. And the earlier you start, the more time you have, the less adjustment you have to make, the less contribution you have to make, because you've got more time for it to work for you. So hopefully that has given you a sort of compelling understanding of the benefit of contributing to superannuation from by pre-tax salary sacrifice arrangement. Now, if you're in the situation whereby you're able to contribute into superannuation and you've used up your concessional limit, so remember that's $25,000, it is also possible for you to make contributions into superannuation from your after-tax income, and that's called a non-concessional contribution. So an after-tax contribution can come from your weekly or fortnightly or monthly pay. After you've made a salary sacrifice, you can't make any more because you've reached the cap. You can decide, I would like to make more super contribution. You can make it after tax. Now, that's through payroll. The other way is that you can just make a ad hoc lump sum contribution at any time. But what you need to be mindful of is there is a cap on that, or there's a limit on that. That's called the non-concessional limit. And that limit is $100,000 per financial year, with provision that if you were wanting to put more, you could, but you would be triggering the bring forward provision. So you're able to do so by contributing for the 3 years in advance. So that applies if you're under 65 years of age. If you are between 65 and 67 years of age, you can actually still make superannuation contribution, even though you're retired, but you cannot do the bring forward provision. And then from age 67 to 65, you have to be working and eligible to contribute into superannuation to make a non-concessional. And then from 75, you can't make any contributions at all. So those are the two types of contributions that you can make: the pre-tax through salary sacrifice, personal deductible, or the post-tax. So with the post-tax contribution, because you've already paid income tax, you don't pay that 15%. So what is the advantage? The advantage is your money's growing under a low tax environment. So while your money's in their superannuation account, you're not paying income tax on the investment earnings. So it gets to keep more of the investment earning and grow more effectively. If that money was sitting in a term deposit or a bank account or a managed investment, every dollar of income generated, you've got to declare it in your tax return, and you'll be paying your marginal rate of tax, which is at least 32.5%. When it's in superannuation, that doesn't come into the picture. It's growing in the superannuation environment. So that's the advantage of the superannuation structure. Of course, there's a trade-off, and that trade-off is that you are putting money away for your retirement. So you would have to wait until you're retired, which is at least 60 if you're born after 1964. But for the majority of us, if we're saving long-term, that's probably the time that we'll want to draw on that money, when we're retired. If you're saving with the view that you're going to spend it for retirement, then superannuation may not be the right structure. The other thing I wanted to add is that if you haven't purchased your first home, there is the First Home Owners Superannuation Scheme. So if you're putting your money into superannuation, you could potentially draw up some of that money towards a deposit on your home if you go down the path of purchasing a home. There is some limits and there's some rules. It's really important to get all the information. But even if you don't draw it out, that money's going to be there for your retirement. So that's really probably the biggest significant difference that you can make to building your superannuation. Making that extra contribution over a long period of time is going to be significant, and I'll show you some financial example later of what that difference will be. The other way in which your superannuation can be further enhanced is for you to make an effective investment decision. So for most people who are joining a superannuation fund that's an industry fund, for example, if you haven't made an investment choice, the trustee will make a choice for you. It's called the default option. And for most superannuation funds, the default option were designed so that they can suit all the members in the fund. So the actual risk profile may be different from what you're comfortable with. So it's really important for you to have an understanding and actually take control and make an informed decision on which investment option will best suit you. And the thing you've got to really try and understand is if you've got a long-term investment time horizon, and I mean that's 10 years, 15, 20 years, then you have the time to be more aggressive in your investment choice, and that's going to pay back in terms of a better return in the long run. You will be exposed to higher volatility risk, but that's something that you have the time to be able to ride out. So you need to understand that, of course. And then if you are uncomfortable with risk, what you'll have to do is compromise your return. And you can also make a choice in that regard as well. So with most funds, you're going to have an investment choice. If you don't make a choice, the fund will make it for you, but it is much better if you are engaged in that decision and make the choice yourself, because you could potentially enhance the return of your superannuation. And particularly, you know, the money's sitting there. You want it to work as hard as it can, because that's what's going to be paying you when you stop working. So in Australian Catholic Super, we have 14 different investment options, and we can help our members through our phone advice service or our financial advice service to make an investment choice based on an understanding of their risk profile, their investment time horizon, and their needs. Now, this is not so much about enhancing your superannuation balance, but it's about understanding the insurance cover that you may have opted in inadvertently by having a superannuation fund open for you and not being aware that a lot of funds have default insurance level of cover that they assume you opt in unless you have actively decided to opt out. And what I mean by that is the insurance cover is typically going to be a certain amount of life insurance, total permanent disability, these are lump sum insurance policies, and maybe income protection. It really depends on the fund. So with the insurance cover, it's important that you're reviewing it and making sure that it's tailored to your personal situation. So you don't want to be paying for insurance that you might not need, or you might be underinsured and maybe you need to adjust it up because of your circumstances. So really important to have a look at that. So the illustration I'd like to go through today, we talked about how to improve your superannuation through consolidation. That will help with regards to making it more efficient for fees. This example here will illustrate how the actual result will be improved by you making additional contributions or making an investment choice where you're getting a better return. So in this example I've put together is an assumption that it's a single person, could maybe be male or female, 40-year-old. Their retirement is 65, so they got 25 years. They're starting with a $50,000 superannuation balance, and their salary is $100,000, but it's growing with inflation. And the only thing that's going into their superannuation at the moment is the super guarantee payments. So on the left hand, you can see that the projections can illustrate what sort of retirement income and what sort of superannuation balance that they would receive or would grow when they get to 65. So this is in today's dollars, by the way, so it's been discounted back for inflation adjustment, so you can get a sense of what it's buying you today. So in this case, super guarantee payments only, we end up with about $407,000 of lump sum, equivalent lump sum today. When we retire, we convert that and start living on it. Assuming that you want that money to last till age 90, this is the assumption, then the calculation also includes eligibility for age pension, factoring in, says that that could potentially give you a retirement income of $37,776 per year from age 65 through to age 90, taking into account eligibility for a part age pension, which graduates up as the assets decline. So that's not putting any extra money in. So as I said, if you don't do anything, your superannuation will still be quite a large capital amount and significant, but for most people, it probably would not provide them with the comfortable retirement income that they may be accustomed to.
Tina, before we proceed to the next slide, I just wanted to mention for our audience, if they have any questions, to put in the chat box, and we'll be answering the questions at the end of the presentation. Thank you.
Now, on the second illustration, the example I have here is if you decided, okay, I want to get a better outcome than a retirement income of $37,000. Let's start with 5% salary sacrifice. Now, I've only mentioned 5% as an example. Obviously, you could put more as long as you're within those caps that we talked about. So in this case here, we've got super guaranteed payments plus an extra 5% of salary sacrifice going in. The basis is exactly the same. And you can see there that the lump sum has now increased to $548,812, but with that extra 5% salary sacrificing. So you're giving up, say, this is for example of someone earning $100,000 a year, giving up $127 a fortnight, which is about $60 a week, to put towards your retirement savings. The result is significant difference. And if you see on the left-hand side, what it translates to is a retirement income of $40,878. So you've already straight away increased your annual income by $3,000 by making that little small adjustment of making a salary sacrifice contribution consistently for that 20 years. In this illustration, number 3, we enhance it further by making more effective investment decisions. So more aggressive investment decision, the example here is not any particular option, but to illustrate what a 1% extra earning results in terms of outcomes. So super guaranteed payments, 5% salary sacrifice, plus investing more aggressively where the result isn't a 1% return greater than the previous example. We again see the superannuation balance has been bumped up to $628,000, and the retirement income resulting from that is $42,786 per annum. So just those little small adjustments, starting early and having it over a longer period of time, can really make a significant difference to your retirement. So in this example here, a retirement income of $42,786 is the current estimated comfortable retirement for a single person who owns their own home. So as you can see, the shorter the time you have, the bigger the contribution you have to make to get the same outcome. But the earlier you start and the longer you've been doing it for, the greater that that difference will make. So hopefully that will give you some idea of what you can do to get a better outcome with regards to your superannuation, because the harder that money works, the more you're going to get paid when you stop working. And I call putting money into superannuation paying yourself first, because that's what's going to pay you when you stop working.
Thank you, Tina. So what can I do right now? One of the ways that you can get in touch with your superannuation account, ensuring that what your investment option is, if it's the right option for you, ensuring that you have adequate insurance on your account, having a look at if your contributions are up to date, what your limit is, if you're contributing all the monies in your account, your account balance. You need to have a login to your account via our member portal if you're a member of Australian Catholic Superannuation Fund. Another way to communicate with your superannuation is by discussing it with your local regional manager. And we have our local regional managers in every city in Australia, almost every city. You can also talk to our financial advice team, which Tina is one of the members of the financial advice team. Now, I'm just going to go through what you can do if you're a member of Australian Catholic Superannuation Fund, and what you can see if you log into your member account. Our member portal is a great way to keep on top of your superannuation. From working out your balance, seeing what your, as I mentioned before, your account balance is, looking at your contributions, whether you've reached the limit that you need to pull back and not contribute as much for that financial year. It's available to you 24/7, and you can keep it up to date by updating your communication status. You can look at your contact details, whether your address is correct, your email address is correct. You can update all that information by logging into your account. You can look at your investment options if you need to change them, of course, after having a conversation with a financial advisor, that is. You can look at your insurance, whether it's adequate for you, and if you need to increase it, you can always increase it by logging into your account and going through the process. You can nominate beneficiaries, and there are many other things that you can also do by logging into your account on the member portal via our website. You can see your statements. A copy of your statements are all there for you. So it's a great way of ensuring that you're up to date with your account. If you're not looking at your statements and you're just getting them mailed to you by the fund and just putting it or filing it appropriately. So this is a great way of keeping track of your superannuation. Now, I'm going to just hand over to Tina. Tina's going to explain to us how a financial planner can assist the fund members and everyone in general. Thank you, Tina.
So knowing about the superannuation rules and understanding contribution and caps, sometimes it's still difficult for individuals to try and make sense of how it relates to what they need to do. And that's really what financial planning is about. We start with identifying and working out what are the goals that you're trying to achieve and putting some time frame in it. And then we can look at the solutions that will best help to get you there. And some of that solution could be, starting a savings plan because you want to build up a deposit for a home. Some of that solution could be increasing your superannuation contributions within the caps because you've got a retirement goal that you want to have a certain amount of income and it's also tax effective. It could be looking at how strategies on how you can pay off your mortgage or your personal loan or your credit cards more effectively and how that fits in overall with your financial planning. So we can really help with all sorts of things, but in terms of superannuation, we do use that as a vehicle to build retirement savings because it's such an effective, tax-effective structure to do that, and it's simple. But it's important that we understand how that fits in the context of your overall needs, goals, and objectives. So that's how financial planning can help personalize what you're doing so that it's going to help you achieve your goals and objectives. So what a lot of people sometimes think, and they say that to me sometimes, is they think that you've got to have a lot of money to seek advice. I say if you don't have money, that's what you should be seeking advice to help you get a better outcome. So as long as if you're working and you're earning an income, then you have the resources to make better decisions in regards to what you spend today and what you put away for the future. So advice is going to help you get a sense of direction in terms of being aware of what you're doing, the decisions you're making today and how it impacts your future, so that you can make an informed decision around the balancing of spending today and putting things away for the future. So I think that's more intangible because that's peace of mind of being able to have some sense of control and empowerment of being able to handle your financial affairs. But the tangible things that we can help with is actually strategies that are going to save you tax. So again, it's keeping more of your money, making more informed investment decisions so that your money is working as hard as it can within your risk tolerance, and helping you manage your spending so that you can understand the parameters that you've got to work with within the resources you have. So in terms of Australian Catholic Super, we have different advice offerings. General advice, Georgette can help you with that. Our contact centre, that's giving you information of a factual nature around any of the financial topics related to superannuation. Now, when it comes to advice, that's where you want it a little bit personal to you. So we have the limited advice option, which is where it's over the phone and our advisors can provide you with personal advice on things like, salary sacrificing, because you might be thinking, I'd like to salary sacrifice. I'm not really sure about the contribution cap. I'm not really sure what it means in terms of what I would be taking home. They can work that out and help you provide you with personal advice. The other areas of personal advice that our phone team, our limited advice service can provide is investment choice. So they'll have a discussion with you and talk to you about the risk and return trade-off and try and understand a little bit more about your risk tolerance and provide you with a specific recommendation on the appropriate investment choice. And lastly, level of insurance. So this is probably an area that's often neglected. So through the discussion, they can find out what your needs are and determine the appropriate level of insurance cover that you can have. So this is limited advice on those 3 topics within our Australian Catholic Super account. If you're after more than that, that's where comprehensive advice comes in. So comprehensive advice, we expanded further. So in the previous slide, I'd mentioned all the things that we cover. That's what comprehensive financial advice is about.
Sorry. Yeah, and I was just going to mention, Tina, we actually put a form in the chat box. So if anyone would like, if any of the audience, if any of them are Australian Catholic Superannuation Fund members, they can write their details in the form, and we can give them a call if they would like to receive the advice as well, whether it's limited advice, general advice, or comprehensive advice. So that's in the chat box, the link. Is there anything else, Tina, that you wanted to add to that?
So I think the main thing is that with our limited advice, you can get that over the phone. There's no cost for that. There is a cost for comprehensive advice. We have an initial meeting with you to provide some general advice, some education. We can identify what the needs, goals and objectives are, and then we're in a better position to determine the cost for advice, and you can get a fixed price quote for that. So with that comprehensive advice, it isn't limited to Australian Catholic Super. Basically, we have a license to provide advice on superannuation, managed investment and life insurance products, but it's not limited to just Australian Catholic Super. So we can help you, even if you're not a member of the fund, but it is a fee for service basis.
Awesome. Thank you. May I remind everyone again, if you have any questions, please put them in the chat box and we will answer them pretty much after a few more slides. So thank you, Tina. Now, some of you may be aware, late last year, we announced that Australian Catholic Superannuation Fund and NGS Super are looking to merge. Currently, the process is that we're going through a due diligence. It's quite a comprehensive process. What is going to happen is that once all the dot the I's and cross the T's and everything is okay to go ahead, around June, July, then the decision will be made that 100% these 2 funds will merge and will come together, which means that the name of the fund will completely change, will be a different name. And hopefully by February, March 2022, we will be one fund. So NGS members will all become Australian Catholic Super members, will all become as one fund, and will be all transferred into one fund. So we're looking forward to it. We're very excited about it. And hopefully our next International Women's Day webinar will have, a different look and feel for you all. So this is a very exciting news for us. Obviously, you can contact us. We have our 1300 number there, that we are open 6 days a week, even on Saturdays. Our call center still works. As I mentioned before, they're award-winning call center. I don't know how many times they've won awards now, but it's quite a lot number of times that they have won awards. So it's a small call center, but it's very, very effective, and they do a fantastic job here at Burwood. It's an Australian old call center, so it's Aussie. It's not overseas or anything like that. So when you ring the fund, you know that you're speaking to someone who actually understands what you're talking about and can actually communicate with you properly. We actually will obviously have our website as well, catholicsuper.com.au, that you can find all sorts of information on our investment options, on insurance, on salary sacrifice, on a wide range of topics. We have fact sheets on pretty much every topic on the website. Obviously, I mentioned before that you can also log into your account via our online portal as well. And we have the fund office at catholicsuper.com.au that you can contact us if you have any questions about to do with your account or the fund or anything at all. That the question will be answered. Obviously, we are on social media as well, Twitter, Facebook, and LinkedIn. So please, if you haven't already, do follow us. We also have more followers. So like with every other company, every other business now, everyone's on social media. So it's best to be out there than not to be out there, I say. So with that being said, we have a few questions that have come through, Tina, and I'm just going to start off with. someone is asking if you can please go through the salary sacrifice limits again, and if they're going to increase from July.
So the when you say salary sacrifice limits, salary sacrifice are contributions that are measured against the concessional contribution cap. And the concessional contribution cap for this financial year is $25,000 per annum. There is legislation to increase it, although I'm not sure what it is. So it's best to check what the contribution cap is when you're making a contribution decision for salary sacrifice. And again, we have our limited advice phone team. They can help you with that.
Excellent. Thank you, Tina. I have another question. She asks, as I retired at the end of last year, am I able to contribute to my super without penalty? So she's already retired. She retired last year.
So one of the slides were the rules for contribution, and that is that if you are under 67 years of age, you can contribute to superannuation irrespective of whether you're working or not. So it doesn't require you to be working to make a contribution to superannuation up till while you're under 67 years of age. Now, from age 67, you must meet a work test. So I'm not sure how old this person is, but if you're under 67, you can contribute to superannuation. You just need to make sure that you're contributing within the relevant caps. If you're 67 and over, you have to meet a work test to make a contribution into superannuation. So that work test requires that you have worked at least 40 hours within consecutive 30 days in the financial year that you're making a contribution.
Thank you, Tina. The next question I have received in the chat box is, will I have to pay tax if I retire at age 60 and I want to access my superannuation after age 60?
Well, see, that's the beauty of superannuation. You get the benefit of a low tax structure while you're accumulating your superannuation, and then from age 60, it's tax-free, which means you can make a lump sum withdrawal, it's tax-free. You can create a pension account and have a regular pension income, it's tax-free. All the investment earnings within your superannuation in a pension structure from age 60, if you're retired, is tax-free. It really can't get any simpler than that. The simplicity of that means that it's very attractive for you to use as a vehicle, not just in the build-up in the accumulation phase, but also post-retirement.
Excellent. And last question I have in the chat box. The question is there a time frame from when I retire to access my superannuation to when I can rejoin the workforce? So do they have to wait before they can rejoin?
That's a tricky question. So there's different definition of what we call condition of release. This is a condition of when your superannuation becomes unrestricted, non-preserved. And it also depends on your age. So from age 60, if your preservation age is age 60 and from age 60, you actually meet the condition of release simply by terminating an employment arrangement, changing jobs, changing employer. You don't even have to retire. You could go to another job, and whether it's part-time, casual or full-time, but on reaching age 60, changing job, you actually meet a condition of release for superannuation. So you don't even have to have an intention to work or not to work. You just meet that already simply by terminating an employment arrangement on turning 60 years of age. Now it gets a little bit trickier if you're under 60 years of age, and that's really not going to apply to a lot of people soon, because the preservation age currently is 58 years of age. That means that you've got to be at least 58 years of age to meet the retirement condition of release, and because that's progressively going up to age 60. So if you were 58 years of age and you're retiring, then you are making a statutory declaration to say, I'm stopping my job, I'm ceasing work and I intend to retire. That intention is not defined in terms of any time frame that says you have to be not working for a period of time, but it needs to make sure that it passes a reasonableness. So if you do intend to work, then you technically don't meet a retirement condition. But if some time has elapsed and you decide, oh, I'm bored, most people don't tell me they're bored when they get to retirement, but let's say I'm bored, or someone's offered me a job that I really want to do, then it doesn't prevent you from working. You just need to make sure when you made that declaration, it was a genuine intention to retire.
Thank you, Tina. That was a great explanation to that question. Now it's just about to turn 7:20, and that was the last question. Unless there are any more questions, I'm not sure they're not coming anymore in the chat box. Please, now if the link is there in the chat box, if you do want to receive financial advice, or if you have any other questions, please don't hesitate to fill out the form. There will be also an email that will be sent out to you as well with the form. So hopefully you can reach out to us. As I explained before, we have our website as well, and the call center that you can reach out to us as well anytime you need. If you have any questions, we'll be more than happy to help you with all that. So on behalf of myself and Tina, we'd like to thank you for joining us again this evening, taking your time Thursday evening to join us. Really appreciate it. We hope you've enjoyed the short webinar and taking something out of it. Hopefully we have made a small change, in your thinking to look at your future in a positive way, and hopefully we have empowered you in some way, shape, or form that you can make some more informed decisions for your superannuation future and get excited. So stay safe, everyone, and thank you so much for joining us again this evening.
Great, thank you, everyone, and let's close that gap between superannuation balances for women and men.
Exactly. Get empowered, women.
Okay then.
Thank you.
Good night, everyone.
Good night, everyone. Bye-bye.